How quickly they fall. Jefferies went from helping Knight Capital out in August, then September, reported a record quarter. October, Moody's says not so fast, downgrades them, and here we are in November, and they're hooking up with Leucadia. So, Stephanie, I mean, they said they had the best 9-month history in their company, and yet now all of a sudden, they clearly had to do this deal.
It's not surprising. It's a very competitive environment right now. The boutiques are having a real hard time. These guys have had a great run, though. They've had really good growth. They've got a good product. They've been diversifying. The problem is capital. And how do you compete with the big boys? How do you compete with the Goldmans and the Morgan Stanleys and the JP Morgans? And so while this fit makes a lot of sense because it'll give them more capital, to me, it's an admission that the environment is still very challenging, even for the more successful boutique companies.
We did recently see KBW hook up with Stifel, and so I would expect we're going to see more of this.
Absolutely. You have, excuse me, you have a very competitive environment, as I mentioned, but you also have very tight spreads. And it's very hard to make money in the capital markets business. So what you've seen is a lot of these boutiques really expand their platforms, not only fixed income, but obviously their investment banking business, which is where they really make money. But we know that there haven't been that many deals when you compare over the last several years. So it's just a very challenging environment. To me, the most surprising thing is that it didn't happen sooner, that we haven't seen the consolidation sooner because of the struggles in the environment overall.
I know a lot of the guys in that business, you know, their customers are not flipping their bonds like they used to. They're buying, they're holding the prop desk bonds. So it has been a hard market for them. Is it best to stay away from these names? Yeah,
I would say that, by the way, these stocks, these companies that are being bought, it's not too expensive. You know, you're talking about 11 to 13 times estimates, 1.2 times tangible books.
They look cheap.
They are very cheap. So I understand why you have some of these bigger players coming in and getting them, and they're getting a very attractive valuation. I would just say, to your question, I don't think you want to be in the boutiques at all. I think it's a hard game to play the takeout story. Why not go with JP Morgan? They're a proven entity. They're trading at 1.1 times tangible book, right? So, and if you really want to own capital markets, you can go to Goldman. Again, I'm more focused on kind of the diversified model, and that's why I stick to JP. KeyBank is a boutique, but it's more of a traditional banking company, and that one trades at 0.9 times tangible book. So I think those two are ways that you can play the space and in general in the environment. And if you want to take a flyer, you know, I think certainly Jefferies has done the right things in the last couple of years, but I just don't think that's really where
Sounds
you want
like
to go.
Stephanie's saying, go big or go home.